Welcome back, investors, to Ticker Time News. I'm Adam, and in my last semiconductor video, the industry looked great after Qualcomm, ticker symbol QCOM, posted an impressive beat and raise report. But those good vibes are diminishing in the wake of Intel's ticker symbol INTC downside Q2 22 EPS and revenue guidance. The chip giant's gloomy outlook is clouding over better than expected Q1 results that featured a 22% jump in revenue for its data center and AI segment. Unlike Qualcomm, though, Intel is experiencing a slowdown in its core markets, PCs, notebooks, and laptops, due to softening demand and component supply constraints resulting from COVID-19 lockdowns in China. While battling against those unyielding supply chain issues and rising inflation, Intel is in the middle of a major strategic overhaul as it looks to greatly expand its manufacturing capacity in the US. The company's long-term vision to rival Taiwan Semi, ticker symbol TSM, as the world's largest maker is compelling. However, the pathway to reaching that point includes some deep pitfalls, most notably in the form of margin compression. Remember last October, Intel announced that it expects non-GAAP gross margin to dip to 51 to 53% over the next 2 to 3 years before starting to improve. For some context, fiscal year 21 non-GAAP gross margin was 57.7%. With Intel already anticipating that its capacity expansion plans will pressure margins, the supply chain disruptions and rising costs due to inflation couldn't come at a worse time. Following a 5.7 year-over-year percentage point drop in gross margin in Q1, the company is now forecasting that gross margin will decline by another 130 basis points quarter over quarter in Q2 to 52%. Intel's gross margin performance will be a key story throughout the year, but its Q1 report and guidance also offered a few other key data points. The Client Computing Group, which is Intel's largest business at 56% of fiscal year 21 revenue, experienced a more profound downturn than expected, with revenue down 13% to $9.3 billion. Concerns that PCs and laptop sales are slowing were seemingly confirmed. Particular weakness was seen in the consumer and education markets. COVID lockdowns in Shanghai and efforts by OEMs to reduce component inventory levels made the problem even worse. Like last quarter, the data center and AI segment capitalized on robust demand from hyperscalers like Facebook, Microsoft, Alphabet, and Oracle, fueling strong sales for Intel's processors. Revenue for the group was up 22% to $6 billion, helping to offset the sluggish PC demand. It's worth noting, though, that data center and AI lapped a favorable quarter in which revenue dove by 20%. What's surprising is that Intel kept its fiscal year 22 guidance intact despite its downside Q2 outlook, forecasting EPS of $3.60 and revenue of $76 billion. To achieve these targets, a significant improvement in the supply chain situation and an acceleration in PC sales must occur in the second half of 22. Based on the stock's reaction, it's evident that investors are skeptical that Intel will meet that guidance for the year. From a broader perspective, Intel's earnings report showed that the landscape in the semiconductor industry is uneven. Although every chip company is dealing with supply chain issues, those with more diversified end markets, like Qualcomm, are better positioned to navigate through these headwinds. For Intel, its substantial exposure to the slowing PC market is upending its performance, while its manufacturing expansion plans are putting a serious dent in its margins. What are your thoughts on Intel's earnings report and the semiconductor industry as a whole? Let me know in the comments below, as your comments help us all to better understand. Help us out by smashing that like button, sharing this video wherever you can, and join us in beating this crazy market by clicking the first link in the description. And if it's your first time watching, click subscribe. For Ticker Time News, I'm Adam. Thank you so very much for watching. and I'll see you in the next video.